Hi. Okay, good morning and good afternoon or good evening, depending on what part of the world you are sitting in. My name is Michael Filighera, and I am the chief cook and bottle washer, so to speak, at TradersHelpingTraders.com and LogicalSignals.com. And little history on me is that I entered into this business in 1979 on the Pacific Options Exchange here in San Francisco. And I have been many functions there, but eventually I took up a friend's offer and became a market maker, an options market maker. And I've traded options here in San Francisco, on the London traded options market, on the European Options Exchange in Amsterdam. And also, I got my introduction into all electronic trading on the DTB, which is the German exchange. I returned back to the United States in 1997, went back to the Pacific Exchange, and that was just as we started to peak back in what I consider the NASDAQ's big, great crash, which was 2000 to 2002. And after that, markets began to slow down and everybody started to leave the floor and everything started to go electronic. And so I eventually did the same. And I left the floor and set up in the home office and I continued to trade options. But about 2011, I determined that, you know what? I'm kind of getting tired of the options market right now. And so I became a day trader. And so I've been a day trader ever since, and I've started some interesting things there. In terms, I've had trade rooms. I have two um, channels on YouTube, and one is membership right now, and the other is everything public. And but I'm getting ready to change that back on my channels. And so I cover the S&P and the Nasdaq, doing a morning and an afternoon, and then also a weekly update on those markets. I also cover the Dow, the Russell, gold, silver, platinum, and the treasuries. And so quite a big thing, plus do trading, where I do have a live stream, aka a trade room. So the title of this is our favorite indicators. And my favorite indicator continues to be the one that I've used since 1989, and that is Elliott wave and Fibonacci. And I learned Elliott wave from Robert Prechter and Dan Ascani in 1988 and 1989. And from there, I began to use it. I was trading on the Amsterdam European Options Exchange and used it very successfully. And so I built it up and I built up my knowledge and I built up my charts and then started to expand. And so I have published my analysis internationally since 1991. And so with all of that, I continue to do it every day. It's what I use. But really, what I want to talk about today is number one, I want to present my long-term view, which is you can see my chart, my long-term view on the S&P 500, which as an index remains what I call Big Daddy. It is the largest. It is the most heavily traded. The options are extremely well traded. And so that's the other part that I want to bring in. I wanted to talk about today changes in trading and what I've added in terms of indicators that assist me being a day trader in the indexes. And the first one being is that some of the changes that I've noticed within Elliott are pretty prominent. And first, let me just kind of go over my big picture view of the S&P 500, which basically is going to be the same for the Dow, and not necessarily the same, but the same type of an outlook in the NASDAQ and all of them basically. So my data for the S&P 500 goes back to 1928. So basically, you can see that I have a lot of years. I have 97 years of data in the S&P 500 in the cash market. And so I started my count with this grand super cycle. Now, where did I get that from? I got that from R.N. Elliott himself. I have many copies of these are all typed on crazy little typewriter. But I have his original copies of his work. And so he was following the Dow and then also did the S&P, but he started by declaring, now he had data that went back further than this. So he came up with grand supercycle. That's the largest or the highest degree that we can use under Elliott wave. And he placed the grand supercycle wave one at in September of 1929. Now this is September. We all know what happened in October. Um, but that was right there. That was the main crash in October. You see, October 29. But the bottom, so that was Grand Supercycle Wave 1 at that high. Grand Supercycle Wave 2 completed at the June lows in 1932. So from at that point is where I started to build my picture. And so what our understanding of Elliott wave is that they are a series of building blocks. So what happens on a grand supercycle degree is that we're now in grand supercycle wave 3. Well, what's going to be inside of grand supercycle wave 3? There are going to be 5 waves of supercycle degree. Like, okay. So we have 1 and 2 in the supercycle degree, as you can see right here. And wave 2 completed at in the 1942 low in February of 1942. Then we start to have to think, okay, what's going to be in a supercycle wave 3? Well, there are going to be 5 waves of cycle degree. Those are the red. And so here's 1 and 2. And so that wave 2 completed in 1949. So in essence, just leaving it right there, where are we? We're in cycle wave 3 of supercycle wave 3 of grand supercycle wave 3. So this whole move that we're now doing and still in is a 3 of 3 of 3 move. Pretty big when you think about the term and how large all of this is. So we're getting very close to reaching the high of cycle wave 3. What is going to be cycle wave 3? What's going to consist of it? What's going to be inside? 5 waves of primary degree, of which we have, and those are the green. And there's my key. Those are the green. There's 1, 2, 3, and 4. 4 being the 2009 low. Now, so what does that suggest? That suggests that we are in primary wave 5 of cycle wave 3. All right, we're going to keep it down to the cycle level right now. All right, so now what's inside of primary wave 5? 5 waves of intermediate degree. Now I'm going to bring this down. I'm going to put it on my 5-year weekly chart. There's intermediate wave 4. There's wave 3, intermediate wave 4. We are in intermediate wave 5 of primary wave 5 of cycle wave 3. So we're closer. We keep edging closer to completing cycle wave 3, which began in 1949. What comes next after cycle wave 3? Well, a cycle fourth wave. And again, we have got its components of what's going to be in that cycle fourth wave. There's going to be an ABC of primary degree. So we're going to be looking to start to count a primary A wave. Don't need to go into greater detail of Elliott wave, but I do really want to talk about some of the things that are changing in that, why I continue to depend on it, and how quantitative algorithmic trading have produced some changes and enhancements to Elliott, and what's really now behind. So I want to be adding one more, which has become my favorite indicator as to how I determine market moves on a day-to-day basis. So here we are. Inside this intermediate wave 5, it's going to consist of 5 waves of minor degree. Remember, building blocks. Elliott wave are building blocks. So we always start at the top to work our way down. But when we're starting something brand new, that's how you would do it so that you can figure out where you are now and then move forward. So we're in an intermediate fifth wave. It's going to consist of 5 waves of minor degree. Well, guess what? We have 1, 2, 3, and 4 are done. Wave 4, minor wave 4, completed on April 7th of 2025. So now we're in to our era of trade wars, tariffs, and other and sundry things. So what's going to be in that minor fifth wave? It is going to be 5 waves of minute degree, of which we have 1, 2, and we're looking for minute wave 3 now. We're very close to completing minute wave 3. So what and how close are we? Well, after minute wave 3 comes a minute wave 4 and then a minute wave 5 up. And then once that's complete, a minute wave 5 would be done, minor wave 5 would be done, intermediate wave 5 would be done, primary wave 5 would be done, cycle wave 3 would be done. That is a lot of progress and time that will need to be corrected. Now, I want to go back out because this is where everybody jumps and goes, what? Elliott wrote and taught and continues to teach us through his work of where you're going to, how you can label these things. What are they consisting of? What happens in between, et cetera. And so the main thing that he talked about, and this goes for any fourth wave, that a fourth wave in progress will normally find its terminus, its endpoint, within the fourth wave of one lesser degree. Okay, I'm finishing a cycle degree. So where is this cycle 4 going to find its low, its terminus, its endpoint? Within the fourth wave of one lesser degree, which is primary. And there it is, staring us in the face. I put a big green box around it because that's the code for my primary degree, green. Now, what was in here? Well, we had this run up, which was, a terrific time, market making new all-time highs. We did our first little rundown. We came running back up, and this was 2008. Those of you that were around, you know exactly what happened in 2008, 2009. And this was considered the great financial collapse. But look at it in the whole scheme of things. That was it, from that high to that low. I was there. I was trading it. Many of us that are probably sitting here today, we traded it. It was crazy. It was the world is coming to an end. It was like, oh my God, how many banks are going to go closing their doors? Holy crap, look at what they're doing to Bank of America. Look what they're doing to Merrill Lynch. Look what they're doing, et cetera, et cetera. Well, out of that came this, the final, the final countdown, so to speak. And we can talk about what created it, what happened here, that this decimated corporate world, corporate America, basically, because this is where we live. It decimated corporate. So what had to happen? The government had to jump in and come up with a plan to basically refund business, large and small. And they did. And it was successful. It was very successful. So what happened? We started to go up. Why? Low interest rates, cheap money. Now, this is 2009. We're 16 years into basically cheap money. We're going to go up here. See that little thing right there? That was the pandemic. That was the next thing that really gave us a burp. Now, what was the pandemic? The pandemic is when we got told to stay home. We could not go out. We were not allowed to go out. We couldn't go to our job, so everything became inside. What really gained value? Zoom, etc. And what happened then? Well, people that were dependent on a service industry for their money, because that's where they worked, they needed to be able to pay the rent. They needed to be able to pay their bills. So here comes the government one more time with a stimulus to give money to us, the retail, right? I always consider corporate, those are the companies. Retail, that's us. That's every last one of us. And as a trader now, I'm a retail trader. Professional, yes, but I was professional standing on a trading floor. I paid to have a seat. I paid to be on that exchange. I had an agreement with the exchange to provide certain things. Now, having said all of that, the final zip up is still underway. And what's the big scream right now? Lower the rates, lower the rates, lower the rates, lower the rates. And it's a mantra. And it's one that has some validity, but basically doesn't. And there's several reasons why. We're not here to go into them. But what I am here to talk about is the fact that we're very, very close. And I'm going to bring this down and put it on my daily because there's the bottom of minor wave 4, and here's the balance of what we're doing. So my forecast is we have within minor wave 5, there are going to be 5 waves of minute degree. Those are the ones that are here in this whitish gray color. There's 1, there's 2. We're getting ready to finish wave 3. Now, what will be inside of wave 3? See, these are building blocks. You see, it's why I become very repetitive. It's 5 waves of minuet degree. And here they are. And now we're in minuet wave 5. If we're in minuet wave 5, that's just going to finish minute wave 3. And my targets are right here. We've already gotten above this one. And that's today. That's right now. And we're going again. They're pushing up. And I think we get up to in here, or maybe even as high as 6478, possibly as high as 6500 in this finishing wave. And then we're going to be finishing minute wave 3. We go through a minute 4th wave. And then let me bring it down to my hourly chart, which I can't even fit on anymore. I should have. Let me go to my 4-hour chart. So we have 1, 2, see, then 1, 2, 3, 4. Now we come up here, we get our 5th wave in. Let's say we get up to this level, almost to 6,500. Well, then what actually does Elliott continue to tell us? If we're looking for a minute 4th wave, well, the minute 4th wave should find its terminus, its endpoint within the 4th wave of 1 lesser degree. Well, from minute, what's 1 lesser? Minuet. And there's the low. So basically, if we get to 65, I'm looking for it to pull back to 62. Pretty healthy. So now you can start to determine, well, because I still got one more leg up, and what's that? Well, I also use artificial intelligence now. Artificial intelligence continues to tell me, depends on what you ask for, right? But I'm looking for what is the Elliott view going out to the end of the year. And it basically is saying between October and December, we should have a pretty strong surge higher, a surge up. But trying to put the actual fine tuning on that, we got to wait because we got to see how those waves are actually going to count. Because the one thing an algorithm doesn't have the best success at is trying to determine one that extends like this one did. This 3rd wave extended, not once, but twice. So we have to take into consideration. So my point is that what I'm using now is telling me that, well, we should be reaching the high of cycle wave 3 between October and December of 2025. And before we even get there, I'm looking for one more sizable pullback in the way of a minor 4th wave. So if I just go, see, that was a very large. What if it gets up to there? That's a very large. Your fibs that you're going to use, you're going to connect where wave 3 started. And you're going to, oh, come on. And you're going to take it up to the end. And let's just say we get up here. Let's just use this top side, 78. There you go. I'm going to put it right there. So most common, now we're adding Fibonacci, my other very favorite indicator. So then we also know just from fibs and through time that the most common retracement, Fibonacci level retracement for a 4th wave is 38.2%. Well, that brings us back to 5950. Now, I want to take a stop. Let's hold all this thought. Now, here's my newest favorite indicator. I don't know how many of you are options traders, But options are ruling the day. I'm sure we've all heard of zero DTE options, but when I first started trading options, we basically had a monthly expiration. That was it. One time a month, we had an expiration where everything got that month came, it settled, it went, and we worked to the next month. Well, now we have zero DTE options. They expire every day. We have weekly expirations. We have monthly expirations. We have quarterly expirations. We have increased the number of trading vehicles that we put options on. We have our indexes. We have futures. We have ETFs. And we have ETFs sprouting every single day. We have commodities, commodity futures options. Every last one of those options has value or things that come into play. Let's put it that way. So I've learned, of course, there are the Greeks. And what are the Greeks? The Greeks are going to tell us if you buy a call or you buy a put or you sell one or the other, what happens? Well, what do you need to do to hedge that option? Or say you buy 100 shares of a stock or an index. And then what does that do? Well, if you're trading the SPX, the SPX is $25 per point. So actually per tick, take that back. $25 per tick, $100 per point. Actually, doesn't it come down or come to 500, something like that. Anyway, it's a lot of money. So you would think that if you're just buying and selling the future or the cash market, um, there's a lot involved. And you hedge it. What do they hedge it with? Options. And so, and you think that these options don't trade? Let me show you how much they trade. Here we are, the SPX. These are the options that are expiring today. 2,400 is the start of that strike price, and it goes up to 8,200. Now, these have been in effect for a while, but look, here we are today, 63.76. I'm telling you right now, that's where they're headed. That's where they'd like to get this. They're going to try to get it. I don't think they're going to be successful, but that was the original goal. So they're going to come after this now. You see that? And volatility has a play. So when you're dealing in options, options have what we would consider delta, gamma, theta, and vega. Delta tells you what happens to the price of your option per a dollar move in the underlying. Well, anything here means nothing. Nothing's going to happen. And the closer that you get to the actual money, see what it does? 98.99. And we come down to where it might take a while for it to get all the way to 100. So yeah, because it's not definitely. So this is like 100. So dollar for dollar. If this moves, this will go a dollar for dollar with it. And so that's the pricing of options. And what's the gamma? The gamma tells you that, again, for each delta move, what happens to your position? Well, here it goes dollar for dollar, right? So do those options, so does your gamma. So there's zero gamma. But when we're doing in something and we're out to where the market isn't trading there, here, you have gamma. And gamma is measurable. And gamma also affects this, your decay. Theta, I know these are all Greeks because they're Greek letters. And theta is decay. Options are created to go to zero, by the way, because nobody's ever told you that. So when you first get them, now think about this. The dealers are the one that you walk into the market and you say, you know what, I think I want to go buy a, a 6340 call that expires today in the SPX. And right now the market is 3670 at 3740. Well, yeah, yeah, it's not bad. It's got 7 cents premium. Woohoo. So, but you can choose one that's not necessarily in the money yet, and you're going to be paying a premium. That premium decays. So let's take this one. The 6380 call is $4, approximately $4 out of the money. It's trading at 340 bid at 350, so you'd have to pay 350 to own this for the balance of today, right? Expires at 4 p.m. Eastern. It's dead. It has no more life. And if it's in the money, well, then you're going to get that. You will also get, the equivalent. This all settles in cash, by the way. If it doesn't, then you lose your money. So theta is the decay. You see the theta? $3.35. Why? Because it's not in the money. So the further it moves away from 63.80, you're going to lose all of it. Okay, so that's the theta. Vega deals with volatility. Volatility is a big game at the moment. Volatility used to be the fear factor. When volatility popped higher, it's because the market was a fear of a decline. That no longer, yes, it's still there. Yes, just don't get me wrong, it still is effective. But what volatility is now is an instrument to trade. So now we have options on volatility. We have a future on volatility. And so what kind of happens with all of these option traders? There's a thing called there's these are my favorite new indicators, by the way. This is what I'm going to be talking about here. And they're actually to where gamma positions get accumulated. And they can be put there by a very large trading firm who just puts a set of options there. And if it's short gamma or long gamma, you'd have to understand the whole concept of gamma and what that each means. But if it's in a certain position, and we call it a call wall or a put wall because it could be in the calls or it could be in the puts. And when it's there and it's above the market and the market goes up and breaks above it, there's going to be an adjustment. And let's say that it's a call wall and it goes up and it breaks the call wall. First of all, what's sitting there to create that call wall are short calls. All right. They're kind of saying, don't cross this line. But if you do, it forces the adjustment of whoever has all those calls. And that forces kind of usually you got to cover them. So, but what these other levels also do is we now have developed, and a lot of this comes from a company called Spot Gamma. And Spot Gamma are magnificent mathematicians. Their models are incredible. Their products are even more incredible. If you're an options trader, you definitely want to check them out. If you're a futures trader, you definitely want to check them out because we can use that data to determine what's happening in the market. And it's not so much as, oh, we're bullish, we're bearish. Many times it has nothing to do with it. An option trader does not necessarily have to be bullish or bearish. An option trader is coming in and they're trading options because of premium. They will sell premium until their heads cave in. Why? Because that's how they make money. And then you hedge that. So there's two different styles that kind of come on there. There's risk on, there's risk off trading. Risk on trading is where they are selling the VIX, which is a cash market. And they're taking that cash and they're buying the underlying, so it could be the underlying in the SPX, the underlying in the NQ, the underlying in the Qs, the underlying in the spiders. They're buying the underlying volatility. Most often it's in the components, i.e. Apple, Tesla, etc., all the way up and down the line. Now, what does that then create? It creates an atmosphere. It creates where we could get what we call a volatility trigger. What is that? It's a measurement. It's a measurement that basically tells you if the market breaks above this level, it's going to signify. So, in other words, if the volatility trigger is above the market and we go up and we break above it, that sends a signal that basically the gamma involved here is going to start to go positive versus negative. Now, what is positive gamma? Buy. You buy. So, risk on trading is a buy. So, you're going to maybe hear these terms from people. Oh, we just broke above the volatility trigger, risk on trading, boom. And what is going to happen? Well, they're going to come in and buy the calls. The dealers have to sell those calls. What's the hedge? Buy the underlying. So all you got to do is think of the actions, think of what's going on. But this affects our market and it also affects Elliott. So those are the main things, right? So how I get to put this together all in the matter of 55 minutes is a wonder. But it's something that if you really look into, it's tradable, it's usable, and it's wonderful. Now, let's talk about risk off trading. Our volatility triggers now are really moving up and down because the markets have been pretty active and I get them every day. And so what really kind of tells me is, for example, in the Qs, I had, let's see where we are. Well, they're at 565. The volatility trigger was 562 in the Qs. That's the trigger. Now it got down there and was trading around it, and it was like, okay, let's be careful because what happens if it broke it on the way down? Well, that's a beginning to signal that we're moving from risk on trade to risk off trade. Well, what is risk off trade? You got to buy the volatility and you're a seller. Risk off, you sell. Risk on, you buy. So if you keep those things in mind, you start to use them when you're trading in the market. Now I'm going to go back, not necessarily the SPX. Now let's go over and take a look at the ES, which is a tradable future, right? Now I don't use a 4-hour chart. I use like a 15-minute chart, but basically I go even smaller. You come down to a 5-minute chart. And guess what? Elliott still works. So again, with the concept of you combining Elliott, now I'm adding some different things on top of that, such as call wall, put wall, large gamma positions, large gamma 1, 2, 3, and 4. We have what we call combinations. Combinations are options that are kind of like if you look at the Qs and then try to figure out, but the Qs are based on the NASDAQ 100. But the Qs are trading at 565. Let's see. The NASDAQ itself, the future, is trading at 23,395. How does that come out to be 565? It's a strange combo. It's a strange mathematical equation. And so because of that, we have, and guess what? The options in the Qs trade way more than the options in the NQ and the NDX. It's like it's easier if you're looking at the S&P. The S&P 500, the SPX, Big Daddy. Those options trade mountains, copious amounts every single day. Large institutions, zero DTE, they love it. Now, oh, they must be bullish. No. Where are they going to pin it? So then we have this other thing. Tomorrow you'll be watching. Watch tomorrow. Tomorrow is a weekly expiration. So not only just because in the SPX they have an expiration every day. Great. And they can pin it. And there are instruments that you can watch. You can get an idea of what they're looking at and where they think they're going to move it according to what their position is. Does that mean they're bullish or bearish? No. My other point that I want to make, we all want to talk about this is a bearish, this is bullish. No, it has everything to do with the options trade and how they're trading and what is being hedged and how they're being hedged and then what the market move. Now, the market does move accordingly with news, with economic data, with news that comes out of the current administration, and it can have a strong effect on our market. But guess what's happening when it's doing that? It's coming down and breaking maybe a call wall, breaking a volatility trigger, moving through a put wall. Those create greater trades that may be in the direction of the emotion behind what's happening. Oh, they're bearish. Why? Well, because we're going to lob 50% tariffs on this country. Well, that's not a positive, so everybody starts to sell. But what triggers it is what's happening in the index and it's happening in the options. And so suddenly, sometimes you'll see it'll stop and it'll just turn and go in the other direction. Why? Well, because a large option trade just took place. And so it really ceases to be bullish and bearish. But the good news is Elliott continues to function in that market as well. Again, like I told you, I come down and I'm using a 15-minute chart. And you can see here, this is the ES. So this is a very low degree. But here again, I can come all the way up to my daily. There I am. This is the daily on the ES. It's the future. There's the minor 4. Here's minute 1 and 2. I'm looking for minute wave 3. How close are we getting? Very. But now you're going to see as I bring it down, I've closed the windows. I'm tightening things up. I have a morning report, and then that morning report, I said, well, we got a little bit of a cluster, small, but the possibility that this might finish it. Why? Well, I'm looking for this being my 5th wave. So if I got this, it's like, well, I maybe 1, 2, and this is like the 3rd, and then we got the 3rd up to here. That was a 4. We're coming up in a 5th. Maybe the same principle, the same, how do I count this wave? No, I don't care if you're on a 5-minute, a 2-minute, a 3-minute, or a 3-year or a 10-year chart. You count it the exact same way. 5 waves up, 3 waves down. 5 waves up, 3 waves down. 5 waves up completes the impulse. A larger ABC down. You count your impulses 1, 2, 3, 4, 5. Wave 2 corrects wave 1. Wave 4 corrects wave 3. Now you can start adding other things. Now, there's only one structure that can represent an impulse. That's 5 waves. But there are up to 13 when it comes to correction. So a market can go up or down much quicker than when it's in a corrective phase. Corrections are pain. Corrections are like, oh my God, I've got 13 different variations that really this could happen. Okay, market, please let it be clear. And sometimes the market's not going to let it be clear, and it's days of sideways to slightly higher, sideways to slightly lower. Days. But your experience will help fill a lot of that in, trust me. But in any case, what we really have going on that's important is being able to interpret, pick up the move, and make some money. As a day trader, what's my goal? My goal is, well, at least 300, 500, $1,000. I have some guys that, they know exactly where to go put them, and they're looking to make $1,500 and then they're done. Not a bad day's work. And by the way, we're both most of the time trying to do that within the first 2 hours. Get it? So, but anyway, we all have our goals. We all have what we want to do. Day trading, sometimes you got to be real nimble, sometimes you got to be quick, and sometimes you can't let things go that far against you. Futures can trade and create big gaps in your life. Because again, here in the ES, it's $12.50 per tick. There are 4 ticks to $1. So it's $50 a point. Big Daddy, the SPX, is 500. That's why it's called the S&P 500. It's 500 stocks, but it's also $500. So in the NASDAQ, each point is $20. So it's $5 per tick, 4 ticks to the dollar. The NASDAQ doesn't move in ticks. The NASDAQ moves in dollars. Or suddenly you'd be down there looking at this thing and say, whoa, wait a minute, it was just trading at 23,400. Now it's trading at 23,089, and that's all within a minute. Oh, and now they just bought it all back in 20 seconds. That's how fast. Depends on if the market's thin, depends on how big the orders are, etc. So what feeds those? Well, what feeds them is the component stocks. So again, when we're using this data, it's like, well, what are we in? Are we in risk off? Are we in risk on? Right now, we remain in risk on trading. Risk on, which means you're selling the volatility and buying the underlying volatility. So you're buying calls in Apple and Google and Amazon and you name it, and Nvidia. And when Nvidia falls out of favor, which it did, right, after hitting its all-time high, came back down to 167, 168, maybe a little bit lower, until someone made a statement yesterday. Oh, by the way, I think AI and those chips are going to be a great thing. Boom. Nvidia caught fire again. Why? Well, here they come, buying all the calls. So it's time to get back on, risk on. And so you know what to do, you know what to expect. You get an idea, how's that going to affect Elliott? Well, it's just going to be a slow walk up. Pullbacks are going to be minimal. Now, mind you, this is a 15-minute chart, and we can do that, and it should spread it out a little bit so we can see. I mean, these moves aren't teeny tiny, they're of good size. But still, when you're doing this, my favorite indicators, first of all, Elliott wave. Second, Fibonacci. I'll run fibs all day long, and you need to know the relationships like this one here, right? This is, let me take it back out to my hourly. I'm looking here. So here we have 1, 2, 3, 4. Why do I have this fib going 1 to 4? Because I'm trying to get the fibs for wave 5. And what's the relationship? Wave 5 is related to wave 1. Starts the sequence, wave 5 finishes the sequence. Then all the rest of your Elliott comes into play right there as well. Wave 1 should be 5 waves in and of itself. Wave 5 should be 5 waves in and of itself, but also is likely going to have an extension within it. Where's that extension going to happen? Well, it's going to happen at about within the third wave. So you're going to get 1, 2, and then 3 is going to break into its own 5. So wave 1 breaks into 5, wave 3 breaks into 5, and you might get the 3 of 3, which breaks into 5. So you learn all this stuff, but you can see how these things build and why we consider the third wave the longest and the strongest, because it contains a lot of points in time. And you're like, well, what's going to create that? Well, we can get over and we can say, okay, well, there was a volatility trigger got taken out. There was a call wall that got broken and gave it the next shove. All kinds of things. And they fit. But if you know what your call is, you're not, oh, did someone get bullish over here? Well, maybe, but who cares? Move's still going to happen. You want to put some parameters around that move. You can use fibs all the way down to a 2-minute or a 1-minute chart. They still work. Here you got it. That's 5 waves down. Yep, 1, 2, 3, 4, 5. So basically either that or this is A, B, and this is 5, C. And it was because you see right now our intention is that we're going higher. We're moving up. So the wave pattern is moving up and more, so it's more bullish. So 5 waves up, 3 waves down, 5 waves up. What do I got? 1, 2, 1, 2. We're subdividing. These are all the things that you'll learn with Elliott. Instead of so we go, well, that looks like 3. It's like, yeah, it does. But try this. 1, 2, 1, 2, 1, 2. Now we're starting to get the third. You see all the little subdivisions? It's because they're all finishing and ending and taking you all the way up to that high. So it gives you some indication that, well, from here, well, yeah, you could get up to there or even higher. And now we're pulling back again. So there's a lot that goes on that what affects the market and could make or break. Now, while I'm still thinking that this should go up, you know your rules that if this is a fourth wave, it cannot break that. And if it's a fourth wave a little bit larger, it cannot break there. If it does, it invalidates the whole count. And you just keep moving and you just keep trading and you just go with it. This is kind of chop. Well, there's a couple of things. Is it corrective? I would say so. It's a little bit impulsive, but it's still corrective. That's the whole thing. So I'm just thinking this is a 1-minute chart. Elliott still works on a 1 minute. You can go to the 5-minute chart. There's the same deal on a 5-minute chart. Doesn't look as bad over there. Oh, look there. One, two, three. There's a four. Maybe we should rally again. Okay, so maybe you decide you're going to buy it, but you want to get your trigger, 5 minute trigger. So you're going to come down here to see where's the best, oops, where's the best idea to come in. Well, let me see. On a 1 minute, let's see if it can break above the 30. I got my moving averages here, just kind of sideways doing nothing. If it starts to break, then I think we get here. If that breaks, we got the sky. So a lot of things kind of happen and you can just help yourself out. So what are my favorite indicators? Well, Elliott wave, Fibonacci, and I'm just going to call the company Spot Gamma. Their models are exquisite. That's all I can say. They're really, really good. And the information, take it to the bank. It's good stuff. And if you understand options trading, you will get it real easy because where the options go, so goes the market. And I didn't make that up. I have to credit Brent Kachuba. He's the architect of Spot Gamma. And so I give him the credit. Um, but it is a worthy subscription. Um, I'm going to open the floor to if there are any questions. I know I go pretty fast. Uh, I know before a lot of people were, like looking for individual stocks. I've only just covered the S&P. NASDAQ looks very similar. Russell, a little bit different. The Dow, not bad. It got about 45,000 again, and that's what it needed to do. So we shall see. Um, thank you, Dennis. I love the fibs as well. I love them. I love them a lot. Um, so in any case, um, I'm not really sure where else to go. I was going to leave enough time for questions. I know my good friend Sunny Harris is coming up next because I can see her, and you're going to really love her presentation and her favorite indicators. I won't spoil it, Sonny. I'll let you tell them. But I'm very familiar with them, and they're pretty wild and they're pretty good. Let me just see. I think some of my other favorite markets are gold, which I continue to look at that. That's a 1 minute chart that's like, wow. But as a day trader, you caught that. It was like, wow. And that's $10 a tick in gold. But if you're out here, you can see that it's still just been corrective. So every time it wants to dip down, see the three-wave nature of that, and then it starts to break again. It's because it's not over. It's not done. So it's staying in its box, and we've already established the box limitations. So I needed about 3,500 before I'm going to really turn like gotta have it. And I think down here, I'm just looking for the support, and then maybe I'm going to get long because we should pick up the rally. The longer term rally in gold is not over in my means, not over. And there's a whole bunch of things that are going to compel it. There's a whole bunch of things that can force it. I mean, we got silver that finally comes sparking to life. Same deal, not over. One, two. Oh, here we're also looking for a minute third wave up here. Might be in, not sure, because I think we got to get up into this cluster. These are my clusters of fib resistance. So these are things I actually teach, by the way, as well. I teach Elliott Wave, I teach Fibonacci, I teach the combos, I teach how do you use these effectively? How do you build that cluster? What does the cluster mean? What do each one of these colors mean? They're the different layers of the wave pattern. They're the different degrees of the wave pattern. Now I'm on a daily chart, so that's the minor, that's the minute, that's the minuet. The goldish yellow, that's sub minuet. The blue is sub, so you can keep going lower. And they still work in the exact same way. So it's kind of, again, I've been doing it since 1989. So, and I know a lot of you probably listening weren't born yet. So, but it's not impossible. It really isn't. And if you stay consistent with it and you learn, do not break the rules. And there are only like 4 or 5 rules. And the other thing I really wanted to talk about and didn't get a chance, but there are some changes that I've noticed, not in the rules, but like in a wave two, in a second wave position. I rarely would see a second wave, which is always going to be an ABC or a combination thereof, but that I would get an irregular B wave in the ABC move. And I'd be like, whoa, what was that? And you're like, but it fit and it did, and everything else came through without breaking any rules. I see them more often than I don't now. And so also just we've also gotten WXYZ patterns. And they're basically just like something that I already knew, which is just a double ABC or a triple ABC pattern, which are corrective. And actually, if you're in a double or a triple ABC and it's going sideways, which is normally what they kind of do, well, then basically you're burning up more time than you are price. Market's indecisive. Markets needs more time to kind of work out what's coming. So it's usually something that's hanging over the market, but they're just going to trade in a sideways fashion until that news or that answer is provided. Silver, I'm still also really kind of big on. Platinum, I like very much. Whoops. But I will tell you, look at that. Wow. We are starting the correction. Thank you, Platinum. We got the minor three. We're looking for a minor four. That's what I'm looking for. Coming back into here. Here's your window. What I will mention in my last couple of minutes here, what I consider the canary in the coal mine. We have an administration that is talking a lot about we don't like the Fed chairman because he won't lower the rates. We need lower rates. It's like, yeah, I get it. Lower rates would be nice, but lower rates will likely drive us into a recession, possibly even worse. Why? Well, consider this, folks. The three major credit agencies have downgraded the United States. Now, we all have credit scores, right? Let's consider. You kind of miss something, you get something a little wrong, and you maybe you're a little overextended, and your credit score drops. Now you don't have excellent credit, you've got good. Maybe you go from good, you go to fair. And you go to try to get a loan or a new credit card, and you're declined. Why? Well, your credit score. Okay, so if we think that happens to us, our credit worthiness diminishes. Well, now it's happening to our country. It's not the administration that's getting downgraded, it's the United States. The United States credit rating has been dropped, it's declined. So the good faith and credit of the United States isn't as good as it was. And why are they downgrading that? Well, because we have $37 trillion worth of debt. And we're planning on adding, I think it's 3.4 or maybe even higher, more on top of it over the next 10 years. Lower interest rates, would that strengthen or weaken our money position? Because we have to continue to print money, right? That's what we do as a government. We have a certain amount that we need every month to pay everything. Well, until we slash it all and don't let anybody have anything, but that's not going to work either. So we're in a little bit of a pickle. And I tell you what, if you look at the bonds, they're letting you know. They're letting you know. We're in a quagmire here, folks. We are closer to going down. And guess what happens? The price of the bond goes down. The yield of the bond goes up. That's not lower rates. That's higher rates. We have a real problem right now. I mean, we're just tracking it along. The 10-year note is down. The 30-year is up slightly. But that's just trading. And you know why? Options. It's options. They have a lot of options to trade in the treasury products. Same deal. The same thing going on, but the overall pattern continues to show that the 30-year bond is likely going to drop below what we call par. Par is 100. That's how they price them, at par. Subpar, hmm, dangerous. So, canary in the coal mine are treasury markets. And you could look at the 10-year note. By the way, the 20-year note, see that auction yesterday? 5%. The Fed's window is four and a quarter, four and a half. Or is it four and a quarter, four and three quarters? Something like that. Actually, it's four and a half. That's their target window right now. The 20-year treasury, 5%. Wow. Wonder why? Because no one's going to go buy it for anything less. So you're going to have to pay more interest, just like this, folks. You're going to have to, if you have bad credit, you go to try to buy a car. Yeah, I'd love to sell you this car, but you can't borrow that money at 2%. That's for very well qualified. But no, we'll give you 9%. We'll give you 10%. And what's your car payment going to be? A whole lot more. All right. I'm going to end it there. I'm going to turn it back to David. Thank you, everybody, for spending some time.